Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo alongside Tom Keene and Paul Sweeney with your opening bell report. So how are the markets going to open on this holiday-shortened day? This is after a rally, and some of the world's largest tech companies really gave the benchmarks a nice boost yesterday. Shares of chip makers like NVIDIA, AMD, Qualcomm, they also had a great day yesterday. So we're off and running. Let's get right to it. We'll start with the S&P 500 up about 0.1%, 9 points at 5,983. We have the Dow, little change up about 14 points at 42,921. And finally, the NASDAQ up about 0.2%, 53 points at 19,816. The two-year yield at 4.35%, that's little changed. And the yield on the 10-year, 4.62%, and that's up about 3 basis points. We have Brent crude, $73 a barrel. That's up more than 1%. WTI crude, $70 a barrel. Spot gold up about 0.1% at $2,616 an ounce. And the Bloomberg Dollar Spot Index is little changed. Since we mentioned chip makers earlier, we'll check in with NVIDIA right now, up about 0.1%. AMD up more than 1%, and Qualcomm up about 0.3%. That is your Bloomberg opening bell report. Paul and Tom.
Lisa Mateo, thanks so much. We welcome all of you worldwide on Bloomberg Television and Bloomberg Radio. We'll monitor the markets for you. For those in the East Coast of the corridor, good morning, 99.1 FM in Washington, up to Bloomberg 1130, and of course up to Boston, 92.9. Acela challenge. Paul, am I right? There's been 2 trains that have been like, it's not going to happen.
They run, they got at least a train every hour going. So, if you miss one,
you say.
You miss one, you just take the next one.
So Winter Wonderland, it's a little cleared up a little bit in New York. It's always important to have worse weather in Milwaukee.
Yep.
We do that now. Dan Maletti of Allspring Global Investments, head of equity, where winter is really winter. And I really want to talk about the future of value investing. I know Allspring is a venerable, I think of John Kerry at Pioneer, or I mentioned John Templeton earlier with his measurement of the Templeton Global Growth Fund years ago. What's the future look like of value investing for Ann Maletti as you shift to the ETF world?
It's a great question, Tom. Thanks for having me on, and Merry Christmas to you and Paul. Look, I think that I like underdogs, not just the Green Bay Packers. I also like small and mid cap here. And I think when we look toward the future, that's where I really see the most value. Certainly those indexes have more financials in them and more cyclical names, but they also have some very profitable companies that have been kind of just ignored by the rest of the market as this Mag 7 area has really taken off.
I mentioned John Kerry, and back at Pioneer of Boston to the Phil Carret era, you'd have a value fund with 100, 150, dare I say 200 stocks. Are you less diversified now in trying to succeed at value versus owning 4 growth stocks?
Yeah, I think we're focused on trying to get investors to think more about diversification. Now, we still are really cautious. You don't want to be everywhere in this market, but there are some really high quality companies out there. And one of the things, I followed small and mid cap stocks for most of my career, which is dating me much longer than I want right now. But what people often associate with small cap companies with is that they're unprofitable. But there's a lot of small and mid cap companies that are quite profitable. And when you look at the earnings multiples of those companies versus the S&P 500, they are almost at trough levels. And so it's those types of companies, Tom, cash flow positive, in many cases, earnings positives, really good management teams operating these companies, but just can't get out of their own way. So diversification, but looking for high quality still.
And I know you and your teams at Allspring, you do a lot of real bottoms-up research analysis. Are there sectors that screen well for you guys in that small to mid-cap world?
There definitely are, Paul, and we have seen financials start to outperform. That is one of the areas that our managers were highlighting earlier. Certainly, with rates coming down, other pressures coming off that area, and not just the banks, but more broadly other financials as well. But I would also say healthcare, and this is an area that a lot of the market has been kind of scared away from, but the tools and diagnostic space in particular is an area that has been underutilized, where you see earnings expected to really ramp in 25 and 26. And so where you see that earnings acceleration, that can actually bring really good returns for shareholders as well.
We get lucky, as we did yesterday with Dana Telsey on Nordstrom's going private. We have Ann Maletti with us from Allspring and Strong in Milwaukee. And this is Joshua Franklin in the Financial Times pretty much moments ago. This was rumored, and now the FT reports the U.S. Banking Lobby Group has said they filed a lawsuit against the Fed over the central bank's stress testing. And of course, the quote here from Greg Baer, "We appreciate the board's announcement as a first step towards transparency." Are we beyond stress tests, Ann Maletti? When you look, I mean, I get JP Morgan's wonderful, but come on. If you look at the top 20 banks after what we went through 18 months ago, can we really get beyond stress tests? That's a mouthful. Stress tests of our banking lobby?
You know, Tom, this is a really interesting article and a comment as well. As you know, where have we seen concentration grow? It's with banks. And there may be more risk out there longer term than less. But I think others would point to private credit and private equity soaking up some of the slack on the other ends, and those areas also funding many businesses. But I don't know. We'll have to see what happens with that lawsuit.
Hey, and a lot of folks with the new Trump administration coming in are expecting M&A to really pick up. Is that something you guys thematically think about for 2025 and maybe beyond?
Absolutely. I think we're already starting to see it. You know, the IPO market is starting to show signs of opening up, but I think M&A is real. There, you know, as you both know, company balance sheets are strong. There's a lot of cash on the sidelines when it comes to what companies have been kind of holding out, waiting to see what the future looks like. With a lower regulatory environment, with rates continuing to come down, maybe not as low as people expected, that's a good environment for M&A. It's another reason we like that small and mid-cap space. You know, these names are kind of ripe and valuations are attractive. And so I think M&A will heat up. It will be a theme into 25.
You know, Paul Sweeney, I look at, we mentioned Ben Laidler in Christmas Eve 2018 with his great bull market call at the time at HSBC. I think I set it up 154%. I can't remember the number, folks, but I got JP Morgan from that same holiday season 6 years ago. Fortress Diamond is up 161%, 17% per year.
Solid.
I thought banks made nominal GDP and you went home.
No,
wow.
Great returns. And they're building a phenomenal headquarters on Park Avenue, which I can't wait to see. Hey, and one of the things I'm trying to figure out where the performance in 2025 could come from after two just stellar years of north of 20% returns. I feel like it's got to be driven by earnings. And sure enough, you know, the earnings growth out there is 12 to 14%. But boy, that seems pretty high. Is there earnings risk out there for you guys? Are you thinking about that?
Paul, I agree with you. It seems high. I would have probably said that coming into last year, or this past year, but we didn't see tremendous earnings growth outside of, you know, a real concentrated number of names. This year, I think we need to see real earnings growth in order to get the market to accelerate. But, you know, the equity market will continue to surprise. I looked at some data going back to 1926, so 99 years. 71 of those years, if we can count this year, which hopefully we can, have produced positive returns, 71 of 96 years. And 32 of those years have produced returns of over 20%. 5 years in a row of 20% earnings. Paul, you will remember this. This was in the fun times of TMT for both of us. 95, 96, 97, 98, and 99 were all plus 20%. So, you'll never know. Maybe we can get 3 this time around.
And Melody, is Apple a value stock?
Tom, the way I love to think about this is value is what you gain, not what you pay. And so I think it all depends on what you paid for Apple and how much more gain we can get. I'm going to use the old Buffett phrase for that one.
Didn't you mention, Paul, like this year? I need to buy my
Apple's
first
up
share.
33%, Tom.
33% this year?
Look at
I
that.
thought they were doing terrible. It's like Tim
China.
Cook. It's terrible. Stop the Road show. Remember the developer shows?
Yeah, they still have them. They're still big events.
So is this like a home run for Dan Ives?
He's had a lot of home runs this year. He can be sitting back
He'll
with
be
his
insufferable.
ugly clothing that he tends to wear or loud clothing that he tends to wear.
Oh, listen to
it works
you.
for him. I know. I'm all over him on that. But he's a Penn State fan, so
Okay.
we forgive him.
Okay.
So there you go.
And Melody on value. Let us continue. A couple more questions here. We're on television and radio worldwide. And Melody, I go back to value, and on an international basis, the number one failure has been strong dollar, resilient dollar, international stocks. At some point, it's going to be a moonshot. When is that?
Tom, I think if we had to pick a dark horse going into 25 and 26, we'd probably take a shot at having some allocation toward emerging markets. And it's exactly, what you're pointing out. The dollar has been so strong. It's really pushed back emerging markets, on top of other things. But I think there is real value to be had when you look at the MSCI EM and index versus the S&P 500. We're at a 20-year trough. And so any kind of positive surprise or weakness in the dollar could really cause that area of the market to surge.
Okay, Melody, thank you so much. Have a wonderful season. Merry Christmas to you. Melody is at Allspring in Milwaukee. We've been doing this, and we're committed to doing more of this next year, where we will have not one but 2 guests from one shop, or we'll have 2 people that cover the same thing from 2 different shops. It takes a lot more work than you think because everybody's schedules are so crazy. But boy, do we finish stronger. I should say start strong in 2025. This is a Nathan Hager, Karen Moscow extravaganza. Bloomberg Daybreak, the first of the year. Ives and Munster will recapitulate 2024. And do you think we'll be $4 trillion by the time that shows
Could
up?
very well be. I mean, boy, it's such a move. But we had Dan Ives and Gene Munster, 2 of the leading voices on technology in our studio recently, and just kind of going through all the big names, the Mag 7, the AI trends, the electric vehicle trends. I mean, some of the big issues, Tom, driving these markets.
Apple up a stick, and I got market cap. You can do this, folks, in the Bloomberg Professional Service. The DES screen. Michael Barr uses it daily. The market cap is $3.88 trillion.
Yeah.
Greifeld says we got to get to 3.9 trillion, then we're on the 4 trillion watch.
Boom, on it.
We'll have to see. Up $1.33 right now.
Yep, so it's good. I mean, you think about Apple, it's a combination of new products. What do they got for you? I upgraded to the iPhone 16 Pro, so I'm now with all the cool kids.
Did you?
Yep, exactly.
You made the upgrade?
I made the upgrade. And then it's about services, Tom. I mean, all the services they generate off of all the devices that we have, they make a very good profit.
All the stars just aligned. For those of you that don't know this, John Tucker has the phone that Michael Douglas used in that movie like
Wall
30
Street.
years ago. Like it looks like a
Money never
lady's
sleeps.
purse.
Yep.
Is Tucker not in the last few days because he's trying to get into the Apple store for the upgrade?
On Fifth Avenue, he's trying to
Could
get
be
in.
he's over on Fifth Avenue?
Yep, trying to get in. He's going to upgrade.
We have a winter wonderland here in New York. As we go to Ari, can you give me the look of New York City? This is Billionaires Row. From Liz Ann Saunders Schwab, this is from her patio. This is Billionaires Row looking across 57th Street and Central Park South over, I'm sorry, it's the Time Warner Center?
I'm still calling it the Time Warner
Is
Center.
it? Lazzetti goes nuts.
I know. Because
The
it's
Deutsche Bank Center?
I don't know. Over there. Great, 59th.
Anyways, we hope you are having a winter wonderland. Seriously, good morning to those stuck in airline traffic. From New York City, Bloomberg's
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, a pretty quiet session ahead of the Christmas holiday. Don't forget, stock trading closes at 1 p.m. Wall Street time. Bond markets at 2 p.m. Right now, the Nasdaq up 0.6%, 118 points. The Dow little changed, up about 3, and the S&P 500 up 0.3%, up about 21 points. The 2-year yield 4.35%. That's little change, and the yield on the 10-year 4.62%, and that's up about 3 basis points. To currencies, the Bloomberg Dollar Spot Index. That's little change. We have the Japanese yen little change at 157.24 against the dollar. The euro little change at 104.08 against the dollar. The British pound up about 0.2%, and we have Bitcoin up 3% at just over 96,000. A few stocks we want to check in with. U.S. Steel are now up 0.7%, and this is after a U.S. National Security Panel had deadlocked on the sale of U.S. Steel to Nippon Steel, leaving that final decision to President Joe Biden. Nippon Steel rose nearly 1%, and shares of American Airlines, well, they're down about 1% right now, and this is after flights resume following that brief grounding from a technical issue that affected all U.S. routes on Christmas Eve. And speaking of the holidays, are you ready for horror on Christmas Day? Yes, the Nosferatu, the movie hits theaters tomorrow. Experts say it's going to break the Dracula box office curse because this one is a scarier take.
Is The Rock in it?
Film. He is not, so I will not be going to see this.
Very good.
It does come out Christmas Day. That is your Bloomberg Business Flash. Paul and Tom.
Lisa Mateo, thanks so much. Paul Sweeney and Tom Keene with you. Michael Barr and Lisa Mateo always helping out on Bloomberg Radio and Bloomberg Television worldwide. Don't forget YouTube, our new distribution. Somebody says, Tom, what do you want? I got enough bow ties. Just subscribe to Bloomberg Podcast. That's the best way to roll here. The Hermes bow ties, they just go up, up, and away.
Do they?
Yeah, they used to be like, it was like 2 martinis, and now it's more.
You have you got to go there, though. It's worth the investment.
Up and away. We're going to spend some time here on the politics of the moment. There's no one better to do that with Gautam Mukunda. Yes, a professor at Yale School of Management, but far more, his book, Picking Presidents, really alludes to the follow-up, I'm kidding, in jest, picking billionaires, Gautam Mukunda now, on Elon Musk into 2025. Professor, thank you so much for joining. And one of your side notes, you say the tension within the Trump administration of Secretary of State Rubio and the newly minted Elbridge Colby versus business types that need to do business in Shanghai like Musk is tangible. Is that what we need to look forward to as a raging Chinese debate at 1600 Pennsylvania Avenue?
It's hard to see how that won't happen. I mean, the big chunk of the Trump administration is people who have defined their foreign policy stance around conflict with China, hopefully not armed, but still levels of hostility that are just a new part of the relationship. And some of the major players in the Trump administration, Elon Musk in particular, more than anyone else, are enormously dependent on trade with China. Musk wants to put billions of dollars of investment into China, and most of Tesla's profits seem to come from China. It's hard to see how those two won't be at loggerheads.
What do you think? How do you think this is going to play out here? I mean, I think a lot of folks in Washington, D.C., a lot of folks who think about policy matters for this incoming administration are trying to figure out what role Elon Musk is going to play and for how long. Do you have any insight into that?
So this is something new in American politics. There has never been a civilian as powerful as Elon Musk. In American history, it's hard to find anyone in sort of like British history or anyone who's comparable. If we go through, he's not just the wealthiest person in the world and maybe the single most important media figure. He's also America's single most irreplaceable defense contractor, right? You could swap out Boeing for Lockheed Martin. You couldn't swap out SpaceX for anyone. So that level of stature is just astonishing and hard to, I mean, he would be a major player in any government. But at the same time, he's sort of shown a willingness to kind of conduct his own foreign policy. He appears to speak with Vladimir Putin on a regular basis and then turns around and kind of tweets out stuff that looks a lot like Russian propaganda. He has enormous financial interests in China that swamp, they may be larger financial interests in China than those of any other person in the United States.
Yep.
And so at the same time, if you're Marco Rubio or Bridge Colby, I mean, what you've been talking about for 10 years is we need to prepare against China. And I'll just note, right now in the sort of the conflict over the government shutdown, the most interesting thing that happened was the initial bill was killed because of Musk. The bill that finally passed did not address any of Musk's concerns with the original bill. If anything, it was worse by his standards, by the ways he was measuring it. But the big change was it stripped out the clause that prevented Americans from making significant investments in China and sort of advanced Chinese manufacturing. That was gone. And somehow the bill passed the second time, which suggests that maybe Musk got exactly what he wanted.
So what are some of the takeaways from that funding bill practice that we saw a week or so ago? It seems like maybe Congress, in particular the Senate, kind of trying to assert its independence of its branch of government. Does that suggest how maybe these first 100 days will go for the Trump administration?
It does, and I think what it suggests is that senators and congressmen are realizing that however much Americans might admire Elon Musk's business success, they didn't elect him to run the country. And, no matter how, there's been some focus groups where even hardcore Trump supporters are sort of looking at Musk's role and going, we did not vote for this guy. So it's not clear what's going on here. But what I would draw back on is I think American politics look more like court politics right now than they do traditional politics. I keep drawing on sort of stuff from the Roman Empire and the Byzantine Empire, right, because this is about clashes of personalities. So the person who springs to mind for me for Elon Musk is Crassus, the richest of all the Romans, the figure who was in the first triumvirate with Pompey and Caesar. I mean, he was a crucial figure in the transition of the Roman Republic to the Roman Empire. And Crassus he bankrolled other people and he played an enormous role behind the scenes. It was incredibly powerful until he decided that he wanted to rule himself directly. And while he had incredible financial skills and incredible sort of backroom maneuvering skills, that was not his skill set. He was not a successful role. He was not a successful politician. And it ended very badly for Crassus.
Professor, we're weaned on, you get this in history. March 2nd, 1861, Lincoln's first inauguration. And I'm sure they had a whole frenzy about pecking order about who would sit where and all that. Where should Elon Musk sit at the second inauguration of Donald Trump?
I mean, judging by his level of influence, he should be right up on stage.
Holding the Bible?
If the Trump, yeah, right. I mean, with his hand right on Trump's shoulder as the
No, but come on, it's going to be seriously. Like, is he on stage? Does he sit 2 rows behind President Biden? Is he out in the cheap seats, halfway back to the Lincoln Memorial? Which is it?
So here's the thing: I would never underestimate Musk's savvy, right? Like he spent $250 million to make himself the second most powerful person in the United States. So if I were giving Musk advice, I would tell him he should be so far away the cameras can't find him on Zoom. That was a smart play for him, is to be as low key as possible, and the Trump people should think the same thing. But I wonder, Musk, like Trump, likes to be the main character. And it's a little hard for me to imagine him yielding focus to quite that extent.
Professor, thank you so much. Gautam Mukunda has been a huge, huge advantage for Bloomberg Surveillance this year. We greatly appreciate his efforts. Readable and advanced. Picking Presidents is the book. Really, really quite something as well. We wander forward here on Bloomberg Television and Bloomberg Radio into the holiday season. I've never seen a season, Paul Sweeney, where there's been less discussion. What are consumers doing? What does the shops look like? What does Walmart look like? I've heard less. I don't know what to make of it. I've heard less talk about that this year than in ages.
Yeah, so I mean, I think what we've seen from the consumer is generally hanging there, pretty solid results so far. You've seen some pretty decent same-store sales coming into this holiday season, so low single-digit growth and maybe in holiday spending.
Yeah.
That's not bad. I mean,
Yeah.
The employment numbers are pretty solid.
Highlight of my day, I got an email from Bramo.
Uh-oh.
Bramo emails in, asks Lisa if she can borrow a bottle of the Kirkland eggnog liqueur.
Wow.
Yeah, Bramo, it's how this is going
That's
there.
how they roll.
One of the offspring called up and said, get whatever that eggnog is.
We do the other egg. We do coquito. That's the coquito. It's the Spanish version of eggnog. Yes, we make it from scratch.
Of
course. It's organic. It's
so
gluten-free.
good. It's gluten-free. It's granola. Have a wonderful holiday season. On Bloomberg Television, on Bloomberg Radio, we continue. This is Bloomberg Surveillance.
right, good Tuesday morning, good Christmas Eve morning from New York City to our worldwide audience. Alex Steele, Paul Sweeney, special simulcast, Bloomberg Markets, radio and TV today. So we can do that for the next couple hours, so that's going to be pretty fun.
Yeah, so now you're into my world now.
I'm in
now
your
we're
world,
into TV.
TV world.
This is how we do things. They're going to write intros for us. We're going to read
really?
intros.
Okay.
You know, it's a whole thing.
All
They
right,
tell us
very
what
good.
to do.
But we still talk about the markets, right?
Yeah, we still
Okay,
do.
very good.
Yeah.
Because the markets here, we got a little bit of a lift to the markets here this morning. S&P 500 up about 25 points. So that's about 0.4%. NASDAQ up about 135 points. That's 0.7%. So again, the last day before the Christmas holiday, a little bit of lift to the markets. Yields pushing higher yet again here. I mean, people have been talking about a 5% 10-year. I don't think they're far off. We're at 4.62% here. So we keep an eye on that. And your WTI crude, Alex, a little bit higher here today, just over $70 a barrel. And again, I watch Landman, so I know all about the energy business, the oil and gas business, and 70 is a good number. So how about that?
Yeah, no, I mean, he knows now. This is what we talk about a lot on radio, that, like, you know, he read the grid, he knows the grid.
Yep.
He watches Landman, now he knows oil. But I have to tell you, did you miss this? We get a 5-year auction today at 11:30. Get excited.
Oh, boy. I mean, does anybody get excited? I know Ira does.
I do.
Ira Jersey. Okay.
I'm going to break it and talk about it,
Good,
maybe.
good.
All right. Okay, well, one stock we are most definitely watching is American Airlines. How glad are you that you're not flying anywhere right now?
No, absolutely true.
Yeah, the carrier resumed operations following an hour-long nationwide grounding on one of the busiest travel days of the year. Joining us with more is Bloomberg's Shelley Banjo. Shelley, what happened?
We're still trying to figure out exactly what happened, but so far what we know is that there was a technical glitch. They attributed it to a vendor that works with American Airlines. So we actually have very little information as to what caused it, but we do know that it did last an hour, as you mentioned, and that so far so good in terms of disruptions. Right now, we don't see a large number of delays. There were about 500,000 or so American Airlines seats flying today, so about 3,000 flights in the U.S. And so it had the impact, or it had the possibility to have a very big impact, but so far, so good.
Shelley, has American Airlines said kind of what happened? I mean, what I hope it was just a glitch as opposed to something maybe nefarious, but I haven't heard really much out of United. What have you seen?
No, American hasn't said anything yet. They said they're working as fast as they possibly can to be able to keep service operational. I think that's their number one priority, especially today. It's one of the biggest holiday travel days, and about 30,000 flights nationwide are expected by the FAA today. So the most important thing, I think, for all airlines is to keep people going where they're going and getting to where they want to go. And, you would think that if it was something big, they would have been grounded a lot longer than just an hour.
It was like the ripples, right? Like one flight's missed and then there's a ripple there. We saw what happened with Southwest. Was that last holiday season?
I think,
around that time. All right, Shelley, thanks a lot. Really appreciate it. Bloomberg's Shelley Banjo joining us. All right, no surprise within the market, but what's leading today is, shocker, tech, but also chip stocks. The SOX index, the semi index, is up by about 0.6%, definitely outperforming. And shares of Taiwan Semi having their best annual performance in 25 years. Wow, touching a record high and showing that the AI trade is definitely alive and well. Co-host of Bloomberg Technology, Caroline Hyde, joins us now. So clearly AI is a key trend for last year. Is it all the chip makers, or had it broadened out?
We keep on hearing the stop-start that maybe we're going to get excited about software, about the application layer of generative AI. And we've certainly seen that in certain stocks. Just think how Palantir has been up and to the right throughout the year. We're up almost 400%. It's entering the NASDAQ 100. But if you go back to the chip sector, that's really where the euphoria continues to be playing out. Look, you're up about 180% for NVIDIA on the year. The stocks having a very nice day yesterday. But even what's been interesting is this play on the international side with TSMC. People loving this contract chip maker, because you're almost not having to pick a winner here. You can back on Apple's chips, on AMD's chips, on NVIDIA's chips, because TSMC makes them all. What's interesting is also the US investor base are so desperate to get in on this AI trade that they're paying pretty hefty premium for the US to put these depository receipts that trade over here in the United States, or over there, I should say. I'm in the UK right now, rather than locally over in Taiwan. But stellar performance for the hardware of artificial intelligence. But will we start to pivot to the software a little bit more?
That's exactly right. And I wonder, Caroline, are investors beginning to ask, hey, how about the returns on all this investment? We see you guys spending lots and lots and lots of money on chips, on data server farms, and all this type of stuff. How about the return on investment? Are we hearing that?
Oh, yeah. And I think that's why we'll suddenly get an addressable market number, even that we can't even get really where the revenue flows are going to go. Sure, NVIDIA's been really the only one to deliver the return on investment that they've been doing for years in R&D. But now it comes to the software play, I think Meta's been doing a very good job of showing how their return on AI investment has worked out, because their advertising presence has just become so much more formidable. They've been able to give the advertisers, the marketeers, so much more bang for their buck, being able to use generative AI, that we have seen Meta the play in terms of return. But when you're still thinking of the Amazons or the Alphabets or those that are having to plow billions into data centers, you're still going to have to wait a little bit, a year or two, until you really start to see the bang for the buck on the revenue side and the profitability side. But we are already hearing from we've heard from software makers, CRM being key, Salesforce, really showing that yes, demand is there for this so-called agent force. Even though the narrative is still very early days and we're still trying to work out what agents are really going to do for us in a generative AI way, they are saying that demand is building, people are adopting, and we'll start to see revenues climbing throughout 2025. That's going to be the proof point.
I love Agent Force, just the name.
Yep.
First of all, obviously it's a show on Netflix, right? But when I was talking to somebody yesterday who was investing in AI, and they were going more of the Reddit track, right? So it's when you sit on the AI stack, there's now so many different ways to play it, right? Some of the best performing stocks in the S&P this year are the power generators that are helping to power these hyperscalers.
Yeah, it has been so much an actual infrastructure play. So power, energy, that has been the way many have been wanting to get into AI. Ultimately, that's the blocker, right? At the moment, we haven't been able to keep chips cool enough. The chips are getting fiercely powerful, but ultimately you've got to build data centers that allow to have as many these chips within them and keep them cool. You need the power for that. You need innovation when it comes to liquefied cooling. But then you do have the application layer. Reddit's a key one. They've been able to make deals with Alphabet, with maybe an OpenAI being able to train to use their data. Then they're able to surface their data that much more and build generative AI within the Reddit product and make us use it a little bit more. The new narrative I'm hearing a little bit more is, how will quantum change generative AI? How will that make training of data ever more powerful, use of data ever more powerful? And quantum stocks have been unbelievable performers. You and I, Paul, talking about Rigetti yesterday, up 1,000% so far this year.
Yeah, just extraordinary. So again, the AI trade seems to be broadening out. It's not just NVIDIA anymore. Caroline Hyde, thanks so much for joining us. Caroline Hyde, co-host of Bloomberg Technology. She is over in London today. And looking at the markets, the best performance is in the tech-heavy NASDAQ, up about 0.8%. Is tech going to lead us again in 2025? Let's ask our next guest, Nancy Daoud, Ameriprise Financial Private Wealth Advisor. Nancy, thanks so much for joining us here. Again, you look at the performance of the S&P 500, broadly defined, north of 20% in 2023, about 25% so far year to date in 2024. What do we do next year? What are you telling your clients these days?
Well, it's always hard to predict what's going to happen next year, but if I had to make a guess, I would say there will be more growth in technology next year. That's certainly where the boom is occurring, but not without much volatility. There's a lot of competition in the space, and certainly a lot of ups and downs. So my best advice to our clients is to make sure you check your stomach lining, make sure you can handle that volatility, because it can be a bit daunting sometimes.
Which leads us, Nancy, to that AI trade, right? Because if you're looking at a structural shift that's going to be maybe less dependent on the macro environment to some extent, you look at AI. Where in the AI/tech stack makes the most sense for you?
It's hard to predict. I mean, I can't comment on individual companies, but I think the tech sector as a whole is a great opportunity with long-term in mind. It has to be for the longer term. The prospects are absolutely positive, and that's what I would go with. If you are in it for 5, 7, or 10 years or longer, there's no doubt that this is where the next boom is.
Valuation, and Nancy, a lot of folks, and you can count me among them, are concerned about valuation here. It puts a lot of pressure on earnings growth in 2025. How do you think about that relationship between valuation and earnings growth in 25?
Yes, I think that is something to be concerned about because some of these are a little dreamy. But when you look at all of the economics around us, there's a lot of bullishness and excitement and optimism, which is kind of nice for Christmas Eve. But there are some things to consider. There's a lot of noise about tariffs. There's a lot of noise about the geopolitical risk. Unfortunately, that's not just noise, that's reality. But overall, the bullishness seems to come from the prospects of tax cuts, deregulation, and the energy, the unleashing of energy. So there's a lot going on that's very positive. So my prospect for 2025 would be more positivity, but maybe less growth than this year.
Do you think we're still in a bull market?
I believe so. I mean, I think you have to look at the year-to-date, year-over-year returns, and you'd have to say this is a bull market.
Hey, Nancy, how about on the fixed income side? What are you telling your clients these days? I mean, 2024, if they were in high yield, if they were in leveraged loans, they're getting 8.5% total returns. That's pretty darn solid. How about next year? How are you positioning fixed income?
Well, fixed income's a little trickier because the bond market has not really gone off it's not as bullish as the stock market. Let's put it this way. There are a lot more concerns on the fixed income side, a lot of weariness and I guess thinking about more inflation, the potential of more inflation due to all of the tariff risks. We're not quite sure if the tariff risk is for real or is it just going to be used as a negotiation tool and what exactly the impact will be. We did have tariffs before when Mr. Trump was president, and it didn't cause any inflation, but that doesn't mean it's not going to cause it this time. So I think that's something that we have to be a lot more cautious about. If you're getting a solid 8% return, I would watch the credit risk on that.
Do you like the long end right now?
A little more cautious on that. We're still watching what the Fed's doing and where they're going to end up.
What do you think the Fed is going to do, Nancy? I mean, and how important is that to just the performance of risk assets next year?
Well, Mr. Powell clearly indicated that the rate cuts will be less next year than expected, and the target inflation rate of 2% is expected to be reached by mid-year 2025. I mean, that's pretty aggressive, but, they might actually do it. Now, the reality, though, for us day-to-day people is that inflation is here to stay. Prices are not going back down. They just may not be going up as much. And some things will continue to go up, of course. And they're usually what I call the non-negotiable expenses, like food, gas, electricity, heat. These are all the things that go up exponentially year over year.
All right, Nancy, thanks a lot. Happy holidays. We appreciate it. Nancy Daoud, Ameriprise Financial Private Wealth Advisor. Thank you very, very much. You know what we're going to talk about next?
Oh, what?
Real estate.
Yes.
One of our most favorite topics.
Yep.
We keep hearing about, will real estate finally find its bottom? Will commercial real estate rebound? What the office market's going to do? We'll have more on that coming up right after this. Equity markets, a smidge higher. This is Bloomberg.
All right, I'm Paul Sweeney in New York City alongside Alex Steele. This is a special edition of Bloomberg Markets on Bloomberg TV and radio. I think that's simulcasting. All right, let's talk a little real estate here, folks. New home sales in the U.S. rebounded last month as builders and consumers sealed deals that had been delayed by storms in the South, and buyers took advantage of heavy sales incentives. Here's what Bess Friedman, CEO of luxury real estate brokerage Brown Harris Stevens, had to say about the market.
All real estate is local, so it depends on where you are and what the demand is. I'll give you an example. A place like Palm Beach, you put something on the market, there is a swarm of people who want to buy, but that's obviously typically more high-end, more expensive. Connecticut, there's no supply. So when people put their homes on the market, there's a rush of people to line up to bid on the homes. So I think once we have more supply, then we're going to get prices to come down. And if sellers start to put their homes on the market and buyers get into the market, we start to see fluidness and supply and demand intersect, which is a healthy housing market, which we didn't have in 2024.
Well, you talk about Palm Beach, you talk about Connecticut. I'm going to be selfish and ask about Manhattan. What does the supply picture look like there, and how does that feed into the pricing dynamic?
We have a decent supply. You know, the market in the city has been pretty flat. High end has done well, which it usually does because it's discretionary. I mean, look at Wall Street. The bonuses are going to be incredible. You know, a lot of people are saying the stock market is obviously pushes or drives the real estate market here, and it's been very frothy, and people are saying, is there a bubble coming? Do we know? I don't. It's unclear to us, but I do think that, you know, it's been moderate, it's been decent. I would like to see a pickup in that market. There's been a big portion of this market that's been cash. So remember, the mortgage rates don't necessarily impact our buyers and sellers as much, although it does play into it.
When you think about that tension, that push-pull between renting and buying, I feel like you're so close to the ground where you see people making that decision in real time. What are they choosing at this point in time? Is there a reason to wait to buy and rent for now instead?
I think, you know, it's like they say renting is more like dating. It's temporary. And so if you don't like it, I have a friend who's renting right now in the Upper East Side, a one bedroom. She doesn't like the neighborhood. She's like, I'm definitely moving out. It's sort of like you're dating before you get married, right? And so I think if you want to commit to economic security and building intergenerational wealth, you buy a home. Because if the stock market plummets and your coinage goes way down, you know that you're looking at your portfolio and go, damn, I have less money. This stinks. Versus if you bought a home and that value goes down, you have a roof over your head, you have a place where you can eat, sleep, have dinner, have fun, and it goes up in value. So I think that we have to think about the housing market as a long-term investment, and it is still the American dream. It's a commitment to your future.
That was Bess Friedman, CEO of luxury real estate brokerage Brown Harris Stevens, joining us on the luxury market. All right, let's go more on the housing market with Drew Redding. He covers that sector for Bloomberg Intelligence. Drew, good to see you. All right, give me your predictions for 2025 for the U.S. housing market.
Yeah, so as you can imagine, the direction of mortgage rates obviously is going to be key in determining how the spring selling season unfolds and how housing ultimately fares in 2025. I mean, if we go back to September, we were looking at a rate at around 6.1%. There was a lot of optimism heading into next year, but that quickly unwound. We're now looking at rates at about 7.1%. So monthly payments are that much higher for buyers out there. So we think it's going to be hard to build a lot of momentum with the affordability challenges that are still out there in the market. That being said, we think that the broader housing space can still grind higher in 2025. With the existing market returning to growth, maybe in the low to mid single digit range, off an extremely depressed base. Remember, we're coming off back-to-back years at around a 4 million annualized rate, which is the lowest in more than a decade. So off of a low base for sure. In the new home market, we think you'll see similar growth, but we think the backdrop will continue to favor the large, well-capitalized, publicly traded builders who have access to financing, access to land, access to the trades, compared to their smaller private peers who tend to rely on that regional and local banking for financing. So they've really struggled with the cost and availability of that capital. So we think you'll see a bifurcation of growth continue to play out.
Drew, I'm going to ask you a 30,000-foot question about housing market here in the United States. We're told that there's a housing shortage. A, is that true? B, how did we get there? And what are your building companies going to do about it?
Yeah, so I think the issue right now is that there's a shortage of homes on the market. A lot of that has to do with the fact that people are locked into a much lower mortgage rate, so they're disincentivized to put their house on the market and trade up to a new home and take on a much higher rate. At the same time, you have to remember back in 2020, 2021, when money was cheap, you had a lot of people going out buying second and third homes. You saw a boom in the Airbnb market. So I think, the housing stock has been allocated in a different way than we've seen historically, which is contributing to that shortage. Now, in terms of what the builders are doing, it's going to be hard for them to put a lot of new supply onto the market, particularly as supply in the resale market starts to heat up. So we think you'll see new home production maybe increase in the low to mid single digit range, which kind of corresponds to what they're seeing from the demand side. But we don't see the issue with housing being solved anytime soon.
I love how we talked about low rates. Thanks a lot. This is my moment where
this
we
is
talk
your
about
moment.
like 275, 30-year fix, and then Paul complains about not being able to refi, and then all the really cool conversations. So then we can, move forward on that combo. The problem is with your builders, as Paul calls them, is that they wind up building, but it's still too expensive for people to buy it, and then they wind up having to give incentives, and then that winds up hurting their profitability. How long does that part of the cycle last for?
That's a great point, Alex. And that's actually one of the key themes for 2025. While we think that volumes will continue to rebound, it's going to come at a cost for the builders. The use of sales incentives is at a multi-year high. A couple months ago when we were looking out to 2025 and we had mortgage rates coming down to the 6% range, I think there was a lot of optimism that builders were going to be able to pull back on that use of incentives, which would support margins into next year. But it's been exactly the opposite. So, we think sales incentives are going to remain elevated. We think margins will come under pressure next year. And it's not just incentives. I mean, you have higher cost land running through the P&L, and you have the potential for tariffs and some immigration policy to add to the margin pressures that these guys are going to face next year.
All right. So a home was just constructed right next to me down at the Jersey Shore. It's being constructed as we speak. And I'm guessing it's swarming with workers there. I'm guessing some percentage of them are illegal immigrants. What are the builders telling you guys about a tighter immigration policy might mean on the ability to actually get these things built?
Yeah, there's some estimates out there that immigrants comprise about 30% of the entire U.S. construction force. And as you mentioned, a large portion of those are undocumented. So in the event that we do get some policy coming through next year, that puts a strain on that labor force, I think what you're going to see is a pullback in production. I think builders' closings could be impacted because you're going to see cycle times, which is the amount of time from start to completion. You'll see them start to elongate, and that could pressure closings. At the same time, builders are going to have to start to fight more to attract that labor. So you're going to see costs rise as well.
Right. So that says a profitability squeeze, it feels like, on lots of different ends. Which companies in your coverage universe do you feel like are best equipped to manage that?
So there's a couple things that we're looking at. One, from a geographic perspective, we think that's going to become increasingly important in 2025. Some of the markets that are struggling a little bit, think of Texas and Florida, where you're seeing a lot more competitive supply. We think builders in those markets are maybe going to have to adjust prices or continue with the elevated incentives. So we think from a geographic perspective, you're likely to see relative strength in the Midwest and the Northeast and maybe pockets of California. From a product perspective, with rates rising, you have to think about who's most impacted by that. And as you would expect, it's the lower end or the entry-level home buyer. So we think that they could remain under pressure into 2025 with relative strength in that move up and luxury segment. So some builders that come to mind would be a Toll Brothers or a Taylor Morrison.
All right, Drew. Thanks a lot. Really appreciate it. Drew Redding, Bloomberg Intelligence Senior Housing Analyst.
As Drew's former boss at Bloomberg Intelligence, I noted that he was in the office today. Not working from home. That has been mentally noted. I'll put that in his file. And
no one will read it and it doesn't matter.
Exactly.
There we go. It's important to sort that one out. All right. Well, coming up, we'll talk more about rates, the Federal Reserve. And also, I'm really curious is the transmission mechanism from the Fed to the real economy. And you can kind of see that in housing. And I'm wondering how that plays out next year. Jennifer Lee, BMO Capital Markets Senior Economist, will be joining us. Quick check-in here on the market. Equity markets closing at 1 p.m. today. Bond market closes at 2. You're looking at an S&P up 0.6%, the NASDAQ up by 0.8%, but volume is super light, like kind of see you January 7th kind of thing. All right, this is Bloomberg.
right, good Tuesday morning, good Christmas Eve morning from New York City. I'm Paul Sweeney alongside Alex Steele. Special edition of Bloomberg Markets. Why is it special? Because we're simulcasting on radio and TV. We can do that kind of stuff here. Hey, looking at the markets here on this Christmas Eve, as Alex was mentioning, the volume's light, as you would expect on Christmas Eve. We got some green on the screen across the board. S&P 500, it's up 34 points. That's good for 0.6%. The Nasdaq's doing a little bit better, up about 0.8% on the yield front. Again, yield's grinding higher. That's how I'm going to characterize it. Grinding higher, up another 3-4 basis points, 4.62% on your 10-year Treasury. And Alex's WTI crude oil up about 1.6%. We're now above $70 per barrel. And since Tom Keene's not here, I'm going to call out Bitcoin up 3.9%. Let's call it 4%. $97,500 for Bitcoin. So remember, we were at 107,000 just like a week or so ago. So this thing's all over the place.
Yeah, we definitely rebated on that. And I love that you pointed out the 10-year yield, right? Because remember, we started the year like almost 100 basis points lower, and now we're higher despite the fact that we've had 3 rate cuts.
I don't understand
Go
that
figure that one out, right?
Understand.
And a big part of that is going to be concerns about maybe the budget deficit and borrowing, et cetera. And the incoming Trump administration is facing the worst trajectory for federal borrowing in modern day history. You got the federal deficit projected to exceed 6% of GDP next year. Bloomberg's David Gura spoke with current Treasury Secretary Janet Yellen about those concerns.
Well, I am concerned about the fiscal outlook, and I believe that deficit reduction is necessary to keep us on a sustainable fiscal course. Now, President Biden signed into law $1 trillion of deficit reduction over the next 10 years. He did that in the agreement to raise the debt ceiling. And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame. I'm disappointed in that, and I think Congress needs to work hard on that. There is a threat going forward that many of the provisions on the individual tax side of the Job Cuts and Tax Act, JCTA, enacted by the Trump administration in Congress in 2017, they will sunset at the end of next year. And many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. So that really is, and so that would be a blow in a situation where I believe an additional $3 trillion, that not doing the $5 trillion and $3 trillion more is necessary. And if the provisions are just extended, this will be a serious blow without finding ways to pay for them. We proposed a lot of pay-fors that we think would fairly ask corporations, wealthy individuals to pay their fair share. We've negotiated an international tax agreement that would create a level playing field worldwide for multinationals. The United States has not yet joined, although many other countries have. And that would be a revenue-raising measure that I think would be very valuable. And there are certainly more. So I do hope that the new administration and Congress will, if they extend features of JCTA, find ways to pay for what they do, and also make sure that the benefits go not to the wealthiest individuals, but to middle-class families.
All right, that was U.S. Treasury Secretary Janet Yellen speaking with Bloomberg's David Gura. You can find the full interview online or on the terminal. Let's continue some economics discussion. We can do that with Jennifer Lee, BMO Capital Markets senior economist. Jennifer, I've been on Wall Street since 1986. It seems we've been talking about federal deficits and the long-term debt of this country forever. Is it ever really going to be an issue for markets, do you think?
Well, good morning, and thank you very much for having me on today. Yes, it is going to come home to roost at some point. When, I don't know. As you mentioned, it's been going on for like 40-something years now, and it continues to go on. As long as there are buyers of U.S. Treasuries, they can continue to keep spending. And I have to say that the first thing I thought about when I was just listening to Janet Yellen was, you've got the opposite going on in Germany, where you're trying to just pry open the wallets because they can't even have a deficit, more than 0.35% of GDP, or let alone 6%. So it's very much of a different situation playing out around the world. But certainly the U.S. deficit cannot continue to keep going at this pace. At some point, again, it's going to come home to roost. And the question is when, and I do not know the answer to that.
Just some breaking news for all you guys sitting in an airport. American Airlines apparently has resolved the tech issue that impacted flights, so everyone can breathe a sigh of relief here. Here's another one interesting, Paul, that banks apparently are suing the Fed. Did you see this?
That, yeah.
Over stress tests, citing the impact on capital levels, saying the vacillating requirements are tough to manage.
Yeah, what's that whole Basel endgame thing?
Yeah.
Which, but the definition, endgame.
Maybe not.
Now, we've been doing this since the financial crisis. I think enough. I'm with Jamie Dimon. Enough's enough.
Enough's enough. All right, we're looking at the S&P Financial Index around the highs of the session, up 0.6%. So, Jennifer, I guess the point is, well, it matters, but I guess when and how and where on the curve.
That is correct. And by the way, I just mentioned just the Fed. I mean, this is like another headache for them.
Of course.
They're already dealing with, issues of how they're going to carry monetary policy going forward. I mean, I remember just a year ago, if you guys remember, the market was talking about 7 rate cuts at one point. Yep. And obviously that didn't pan out. So even now, we're still talking about rate cuts. We've sort of trimmed back our rate cuts. We've sort of slowed down the cadence of how quickly the Fed is going to keep cutting rates. So we've got going down to about 3.375% roughly in roughly 2026 or 3.125 or so. Just slowing down the pace, but anything can happen. There's even talk about possible rate hikes, depending on what happens with tariffs and the impact on inflation. So right now, it's almost like anything goes. It could be hikes, it could be cuts. And of course, we are still leaning toward the cut, way, but of course, just at a slower rate, at a slower cadence, of course.
Jennifer, to what extent are you concerned about what could be some potentially inflationary moves by the incoming Trump administration, whether it's tariffs